So let's move on to inheritance, gifts, and estate taxes. So the estate tax in the federal view was established in 1916. This tax applied to the transfer of wealth after death, initially to generate revenue and address wealth inequality. This is a tax on a person's right to transfer their property at the time of their death. Now, this tax takes into account everything a person owns. Anything he's invested in at the time of death, his cash, securities, real estate, insurance, everything. And this is called the gross estate. And there's only a few deductions allowed, such as funeral expenses. So a certain amount is exempted depending on the year of the death. Now, that's something you have to look into for your own location. That's a little more complicated than I really want to get into. The initial exemption was $50,000 with rates ranging from 1 to 10%. Well, the exemption amount has increased over time. In 2016, it was $5.45 million. So something has changed in our tax laws very seriously for that rate to jump so dramatically. Then there's the state estate tax. So over a dozen states have had their own estate tax with often lower thresholds than the federal level, sometimes starting at like 1 million. And then some states also have an inheritance tax on top of that. So distinct from estate taxes, some states levy the tax on beneficiaries receiving assets from the deceased person's estate. Now, this again varies by state. But this means the person receiving the inheritance, the beneficiary, pays the tax, not the estate. Paying taxes on money that has already been taxed over the lifetime of the deceased? Wow. Now, the rates and exemptions, again, depend on the inheritor's relationship to the deceased. And there are only 6 states who impose this tax. But of course, my state of Maryland has both the estate and the inheritance taxes. Go figure.